Hi guys, welcome back to Father and Son Investing. If you're like me, you have one or more ETFs within your portfolio. Well, recently news came out that Senate Finance Committee Chairman Ron Wyden has proposed a new tax on exchange-traded funds to help pay for the $3.5 trillion budget plan. Now, the measure aims to stop wealthy investors and companies from skirting capital gains taxes on in-kind transactions. If you're not aware of what in-kind transactions are, we're going to talk about this during this video. We're going to talk about what Senator Wyden's proposal is. We're going to talk about how ETFs function and how his proposal then would affect ETFs. And we're going to talk about the unintended consequences of his proposal. So imagine an ETF as a bouquet. It is made up of individual flowers, and each of these individual flowers then are packaged together into a bouquet. You may have a bouquet that is a tech ETF. You may have a bouquet that is an industrial ETF made up of lots of different stocks or flowers. So here we have the fictional ETF XYZ that is based on the XYZ index. In this case, it's a tech index. And so we see Amazon and Apple and Alphabet and 100 other tech stocks. Now, if you're not aware of it, ETFs use authorized participants as middlemen, essentially, when they are creating these ETFs. So the authorized participant will buy each of the individual flowers, each of the individual stocks, and send those to the ETF issuer. The ETF issuer packages these individual stocks into the bouquet and sends it back to the authorized participant, who then will send it back and forth to the market maker. Now, the market is where the individuals, such as you or I, can either buy or sell our ETFs. Now, the nice thing about ETFs is that they are better in handling of taxable events. First of all, when a seller sends his ETF to the buyer, if there has been a capital appreciation, it is just the seller who's going to have that taxable event, not everyone else who holds one of the ETF shares. Now, ETFs are also unique in that the shares can be created or disposed of, and the way that's done is via the authorized participant. So when shares are disposed of or redeemed, the authorized participant will send the bouquet, the basket of shares, back to the ETF issuer, who can then break those back into individual securities and send them back to the authorized participant. We call this an in-kind transaction. There is no cash being exchanged, and thus, with no cash being exchanged, there's no capital gain. In fact, the ETF issuer can also choose which securities he sends back. Once these bouquets are broken up into individual flowers, the ETF issuer can choose which shares to give back to an authorized participant, meaning the issuer can hand off shares with the lowest possible tax basis. And this leaves the ETF issuer with only shares purchased at or even above the current market price and reduces the fund's tax burden. Now, this is in stark contrast to a mutual fund. When a mutual fund shareholder wants to redeem their shares, they send it back to the mutual fund manager, who then sells these shares for cash. This creates a taxable event, not only for the person who is redeeming their shares, but for everyone else who is a shareholder in the mutual fund, such that at the end of the year, all of these taxable events are passed on, meaning the capital gains, are passed on to every shareholder in the mutual fund. Those capital gains then are taxed by the United States government. I don't know about you, but that doesn't quite sound fair. Someone else is selling their shares, and I'm going to be paying taxes on that. With an ETF, there is far fewer cash transactions taking place because of those in-kind stock-for-stock exchanges, and thus fewer taxable events. Now, according to this article in the National Law Review, there will be unintended consequences of Wyden's proposal to change the tax treatment of ETFs. Now, there's a couple of other things to understand about this proposal. First of all, mutual funds and ETFs are two types of regulated investment companies that are subject to the same federal income tax rules. Under these rules, when a mutual fund or ETF sells appreciated portfolio securities, including to meet redemptions, it recognizes capital gain. We discussed that. However, under the current Internal Revenue Code, mutual funds and ETFs may instead distribute appreciated portfolio securities in kind to shareholders in redemption of their shares without recognizing gain on the securities. Now, mutual funds don't tend to do that. ETFs routinely do. So Senator Wyden's proposal would result in mutual funds and ETFs recognizing gain on appreciated securities distributed to shareholders in kind. Now, his proposal would also affect the in-kind exchange that takes place between the authorized participants and the ETF creator. And we explained already how that works. Essentially, this is called the Etf Arbitrage Mechanism. And Senator Wyden's proposal states that the Etf Arbitrage Mechanism results in ETFs regularly disposing of appreciated securities currently without recognizing taxable gain. And it's this last point that is the focus of his proposal. Now, this article in the Law Review states that while one result of the repeal would be to cause ETFs to recognize more taxable gain than they currently do, there are some other unintended consequences. First of all, important to know that there are 12 million U.S. households that own ETFs, and 92% of those households have an annual income less than $400,000, so not just the wealthiest Americans. In fact, the median household income of ETF investors is $125,000 per year. So the Law Review points out that the proposed tax will affect many U.S. investors with an annual income well below $400,000. Now, the Law Review also points out that the current law is important in mitigating systemic risks potentially posed by a run on mutual funds and ETFs. So the Law Review points out that repeal of this current section of the code may be exactly what the doctor didn't order in a time when Congress and the administration are seeking to lessen systemic risks in the financial system. The Law Review article further goes on to point out that many of the tax costs associated with authorized participants' short-term trading of ETF shares will be borne by long-term ETF shareholders, similar to the way that mutual funds happen when somebody sells their shares, that capital appreciation is passed on to the remaining shareholders. They also point out that this added tax could be passed on by the authorized participants to the ETF shareholders in the form of transaction fees, and that can result in wider bid-ask spreads and discounts to the NAV. Now, this proposal can affect an $8 trillion industry. That is the current estimate of the ETF value in America. And this employs a commensurate number of people here in America, due in part to retail investors recognizing the favorable tax treatment applied by the code as it is currently written. So repeal of this section could have a huge impact on an $8 trillion industry. The Law Review article goes on to conclude that by attempting to achieve Senator Wyden's goal, his proposal may actually create unintended consequences, particularly for retail investors, that outweigh any perceived benefit of the repeal of the section. I hope this information was beneficial and interesting for you. If it was, please give us a thumbs up. If it was beneficial and not interesting, please give us a thumbs up anyway. That's really important to the YouTube algorithm. As always, please share this information with a young person in your life. Help them along the way in their journey of investing. And until next time, enjoy your investing.